More and more news of big firms defaulting on their loans is coming up lately.
Brookfield defaulted on a $161 million mortgage.
This is clearly a strategic decision that somebody in a boardroom is making.
What does this mean to the investors? It is possible that they lost all their money, and the capital stack explains why. So in this video, we're going to talk about what is the capital stack, we're going to go over each of the layers, and then I'll explain the risk and rewards of each.
All right then, let's go.
Hello investors, welcome back to the channel, Adrian here. So first off, what is the capital stack? In the context of commercial real estate, the capital stack is a visual representation showing the different sources of funding and the order of who gets paid. The simplest example of this is buying a house. When you buy a house, a bank will typically lend 80% of the purchase price, and the home buyer brings the remaining 20% in the form of a down payment. So the capital stack looks like this. Now the stack can have any number of layers, but it is primarily composed of the debt and equity. Debt can be further divided to senior debt and junior debt. Junior debt is also known as mezzanine debt. Equity can also be further divided into preferred equity and common equity. The way to analyze a capital stack is that the order of priority goes from the bottom going to the top. Only debt is able to secure its position by recording a lien on the asset. That makes debt the safest or least risky position in the stack. And that also makes equity as the most risky position because nothing is securing it other than the promise of returns. So when a sale occurs or a foreclosure, the order of payment goes as follows. The senior debt gets paid first in full, that is both principal and interest. Then the junior debt gets paid, and so on and so forth. Now, you can probably see why the top is the riskiest position. That is because it is possible that there's not enough value in the property to possibly pay the common equity. Here's a quick example. We acquired a property worth $10 million. With $6 million as senior debt, $2 million as junior debt, and the remaining $2 million we raised with common equity. Let's say the property declined in value, and in the point of sale, it is only worth $8 million. As you can see, there's only enough value to pay out the senior debt and junior debt, but there's nothing left for the common equity. Now, being at the top is neither right or wrong. Yes, it carries a lot of risk, but that is why common equity has the highest reward. The debt portion only receives initial capital back, which is the principal, and the fee for lending, which is the interest. And that's it. The debt gets no piece of the upside. Even if the property doubles or triples in value, the debt portion only gets the pre-established principal and interest. The rest goes to the common equity. You have to understand that you can't have it both ways. If you want more security, you have to accept getting small returns. If you want higher returns, you must be willing to take in more risk.
So if using too much debt is risky, why not just use less of it?
The answer is because debt can juice up the returns. Using our previous example, debt is $8 million and common equity is $2 million. Let's say the property appreciated by $1 million. If the property was sold for $11 million, debt gets paid back first for $8 million, then common equity receives its initial capital of $2 million back, and then it receives $1 million of equity returns. That's a 1.5x multiple or 50% return. Let's use that exact same scenario, but instead we decrease the debt to $5 million and raise another $5 million for common equity. That same equity return is now only a 1.2x multiple or a 20% return on capital. As you can see, the senior debt first dictates how much they are willing to loan, which is called the loan to value or LTV. If the LTV is too low and there's no way to make this deal work, to increase the LTV, the operators can bring in preferred equity and raise the remaining with common equity. You can think of preferred equity as a creative tool for the operators to make a deal work. Yes, it's that powerful. But this tool is a double-edged sword, and in that it has its own risk. In fact, a lot of risk. So watch this video next where Perry dives deep into preferred return and mezzanine debt.